Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome to Retiring Well. Listen, I'm really excited because this week on the show, I want to talk about holistic planning. Okay, a lot of people have seen us on TV. They know about Centennial Wealth, but they ask, what's my experience going to look like if I was to, be with Centennial Wealth? What kind of things do you guys do? Well, I'm joined today here by John Torbet. He's a partner advisor here at Centennial Wealth. And John, thank you for joining. We're going to talk about that today, right?
Yeah, I'm looking forward to it, Larry.
All right. Well, the first and obvious thing that people know we do is wealth management, right? But what I want to talk about is the things that differentiate us maybe from a lot of the other advisors that are out there. The first and foremost I got to think about is we employ what's called active management. We don't have people be passively invested in what I call a buy and hold strategy. Wouldn't you agree?
Yeah, and what I think of with that, Larry, is that you have different times in the overall stock market where fundamentals of the economy are maybe pointing one direction or another, and that leads to how maybe you want to structure your portfolio so you're not caught at any one point in time where you're maybe overly aggressive when markets are pretty volatile like we've been seeing as of late, or you don't want to be stuck sitting on the sidelines either when there's a lot of growth potential out there.
Yeah, I think the other thing that most of our clients, soon to be retired, would say is, they don't want a large standard deviation, or what we call a large variance, right? They don't want to see their account drop to half its value ever.
Yeah, and what I think of there is like you've got this bell curve, but basically the way I look at it of sort of your range of returns in any given year. And so, okay, everyone wants to talk about, well, how much can I make? That's great, but especially when it comes to close to retirement or in retirement, it's more maybe focused on, okay, what's your downside exposure to risk in this account? And is that something that you're comfortable with if that were to occur?
Yeah, and that really dovetails into income planning because, you can have an income plan, an account portfolio makes 5, 6, 7%, and you're pulling 4 or 5 a year. That works all day long. But what does that look like if it drops to half its value? It gets very, very ugly. John, the other thing I think is maybe a differentiator is our independence. We can sell a vast array of products with a vast array of companies. We're not proprietarily held to sell any one company's products, which really allows us to be more of a fiduciary. Wouldn't you agree?
Yeah, and that's something in talking with different friends in the financial services industry that may work for a certain company, bank, brokerage house, whatever it might be. They are somewhat limited. I mean, they're required to stay within their company's offerings, whereas being structured independently, that's one of the main reasons that Centennial Wealth Advisory was created is to be able to offer a wide variety of different accounts and investments and whatnot, and ultimately coming back to you as the individual and what are you trying to accomplish with your retirement plan, and then mapping out, okay, here's a number of different options that may fit into what you're trying to accomplish.
I mean, to be a true fiduciary, you have to act in the client's best interest. If I'm a company that I only have limited products I can sell, and I believe that's going to be the solution to all their problems, well, then I don't think I'm being a true fiduciary if there's other things out there that could serve them better.
Right. Most definitely, Larry. That's spot on.
The other thing I think is important is the education we provide. There's so many financial instruments out there. Many of them are very complicated, but they all have what I would call pros and cons. I think the more people understand or clients understand the pros and cons, I feel like the best decision they can make for themselves. Wouldn't you agree?
Yeah, and that's one of the main reasons behind this show, the Retiring Well television show that's been going on nearly a decade now, covering all of Northern Michigan, was to ultimately educate individuals and couples about retirement planning, because I think there's a lot of information out there, and our goal was to ultimately show you, hey, here's some different things to be thinking about, just like we're talking about on today's show, that retirement planning goes beyond just the investment management. It's this holistic approach, and something that we feel is vital is to help you understand, okay, what your different options are, and then be able to narrow it down and help you make an educated decision on what you feel is best for your retirement plan.
Yeah. And then kind of dovetailing back to what you said initially, John, with the wealth management style, it's looking at those fundamentals. You know, things are always changing. One financial instrument at one particular point in time in the market might not be so great during a different time. You know, if we're in a rising interest rate market, how does that affect bonds versus a declining interest rate market, right? So there's a lot of variables here that play a part in educating clients. So listen, I want to go talk now a little bit about another thing that we do at Centennial Wealth, which is income planning. Now, in income planning, it's really coming down to answering those three questions. You know, one, how much income do I need in retirement? Secondly, how much income can I count on that's guaranteed? You know, do I have pension income? You know, what's my Social Security going to be? And then, so if I know what I need, I know what I can count on, where's the difference going to come from, right? It's got to come from that savings.
Yeah, and I think so often, Larry, that folks come in to visit with us here in the office, and they're asking, well, oh, I didn't reach my goal of $1 million or whatever the figure is. What is that magic number that I need to reach in order to accomplish my retirement goal? And that varies so much for every person, every household, because it comes back to what are you spending, and ultimately what are those known income sources, and then that remaining gap. I mean, we've met with folks that have multi-millions, and we have to tell them, I don't think you'll ever retire based on the way you're spending money today. And others that may have 100,000, and when we're looking at the numbers, we see you could probably retire pretty comfortably based on the income that you have and the expenses that you currently have. So it really varies for every household. And so that's where we always encourage you, if you aren't sure of that, then that's where we're happy to sit down and just sort of talk through that with you and help you understand maybe what it is that you may need to have as sort of that retirement savings goal.
Yeah, I think one of the other questions that come in is, you know, that comes into income planning is, you know, when do you take Social Security? You know, do I take it at 62? Do I wait till full retirement age? You know, maybe I wait to age 70, you know, and what's that look like? Well, in an income plan, we can run all those scenarios, you know, and then show somebody side by side which one maybe makes the better sense for them. I love to be able to do that because, you know, a lot of times they don't know what they should do, and when they can see the pluses and minuses of the different scenarios and which direction it can go, it makes it much easier for them.
Yeah, that's where I like those sort of the big picture retirement planning tools, and bringing those in to sort of show, like you said, show folks how to structure that and show them different options. Because again, it may come down to, we'll show you all the different numbers, and sometimes I've found with folks when it comes to, especially to Social Security, sort of that gut instinct of, well, I don't know if I'm going to live past a certain age, and so I'm going to take it earlier rather than later. But it's, again, helpful to be educated on what your different options are there.
Yeah, I think the other thing that, you know, that has to come in an income plan is, how are we planning for the surviving spouse? You know, if they've got pension income and that maybe drops to 75-50% survivor benefit, maybe with Social Security, they know they're going to lose the lesser of the two Social Securities. So, you know, what's that income gap going to be, and are we planning for it? Very, very important. Wouldn't you agree?
Yeah, again, that comes back to that educational piece, and maybe mapping out different scenarios to show, well, what if one of the spouses passed away at a certain age? What impact is that going to have on their surviving spouse? And so often, you know, we'll hear people say, well, my expenses though will drop in half. And we found, you know, unfortunately, being in the business for a number of years and having clients pass away, we don't see that surviving spouse expenses drop that significantly. It may drop a little bit, but there's still the ongoing bills that aren't going to change. And so it's planning for that, and ultimately mapping that out to sort of know, if that happens early, sort of what your expectations should be.
Yeah. Now, John, I think this would be a good time for us to break, but in the next segment, I want to talk about tax planning and estate planning. But I want to just throw one word of caution out to our viewers. All advisors can do an income plan. Most have the software, the tools to be able to do one for you if you want. But there's one thing you need to understand on any income plan that anybody does out there, and that is, they have to put a growth rate assumption in there for your portfolio. Now, if I'm that person if I put a growth rate assumption in there of, let's say, 6-7%, and I'm only pulling 3-4-5% out, well, guess what? That income plan is going to look very, very good no matter what. But here's the point. What does it look like if the market drops to half its value? I'll guarantee you it's not taking that scenario into consideration. Because if I'm that person pulling 3-4-5% out and the market drops to half its value, now guess what? I'm now taking out 6-8-10%. That can blow an income plan. So a part of working with somebody that's having an income plan is making sure, again, going back to what we talked about on the wealth management, stay away from the big losses. Very, very important. So with that, we'll break. Stay tuned because we got some more stuff for you.
We look forward to helping you plan to retire well.
Welcome back to Retiring Well. Listen, in the first segments, we talked about wealth management and income planning. Now, John, I want to start talking about what's called tax planning and estate planning, okay? And one of the things we recognize with people that soon to be retired is one of the savings vehicles they found very handy as they were accumulating wealth, which is, your IRAs and 401ks. They're now, as you get into retirement, the worst asset you can have. Explain that, would you?
Yeah, I think one of the big issues there is obviously when you go to take withdrawals out of IRA, 401k, 403b, et cetera, that money's been earning interest all these years, but you haven't paid tax on that money yet. And when you originally put it in, you got a little tax break initially as well. So now you have accumulated potentially your largest retirement asset and never paid a dime of taxes. So now, as you say, you want to take a withdrawal, all of a sudden now all of that money is going to show up on your tax return. So it's going to be fully taxable to you.
Yeah. And so what we want to do in tax planning is not only minimize tax as much as we can, but we want to figure out a way through taxes to get Uncle Sam out of those accounts, right? Because people have to recognize they got a partner in these accounts, because every time they take $1 out, who's there to take their share, right? Yeah. So how can we buy out Uncle Sam at the cheapest possible way? And that's what really kind of goes into our tax planning. It's what we call an IRA exit strategy, right? So one way we can get Uncle Sam out of an IRA is to do what's called a Roth conversion. Can you explain that a little bit, John?
Yeah, so in my mind, I visualize sort of two different buckets here. So in one side, you've got your IRA that hasn't been taxed yet. And then meanwhile, over here, you create a Roth IRA bucket that ultimately, once you get money into this bucket, then it grows tax-free and future distributions are tax-free. So there's obviously a tax transfer going on. So you're going to pay tax moving from one bucket to the other. And in most cases, you're not taking the whole bucket and dumping it over there. You're just taking a little bit out at a time. But that's something as part of we look at as an annual strategy that you should be reviewing to determine where your income tax falls, and does it make sense to move money year by year from the taxable bucket over to the tax-free bucket.
Yeah, John, I'm glad you brought that up. That should be looked at every single year, because here's a scenario we've seen at times, right? You got somebody who's got their Social Security, maybe pension income, and now they're pulling out of their IRA. And let's say they're in that 22% bracket. All their other income has kind of pushed them into that bracket. So now they can concede that Uncle Sam's going to get 22 cents on the dollar. There's nothing they can do with that. But what if they have room in that bracket, right? That would be a great time to do some Roth conversions, because if you know you got to pay Uncle Sam 22 cents on the dollar anyway, why not do it sooner than later? Quicker you get it into that Roth, growing tax deferred, right?
Yeah, most definitely. And one of the areas that we see is pretty common is when people are retiring, they're thinking about, well, I've got to make this purchase or that purchase. It seems like a lot of our clients as of late are saying, hey, I want to retire, but I want to buy that truck. And so, and a lot of times they want to basically just pay cash and eliminate any future payments from it. Well, one of the main concerns with that is then if that additional income that you draw out of that taxable IRA pushes you into a potentially higher tax bracket, it may not make good financial sense to do it that way. Whereas if you were maybe over the years shifting some money over into that tax-free Roth IRA, to go and take withdrawals from the Roth IRA side would be tax-free. So it wouldn't impact your taxes for that year. And so again, it's one of those reasons that we look at it year in and year out of how do you adjust money over time from the taxable to the tax-free, not only for those purposes, but I know we had talked about earlier in the show that surviving spouse scenario and how big of a potential tax problem that can be.
Yeah, I mean, John, we've seen it when we've run the mock tax returns. You can take a couple taking all that income, and then all of a sudden one of them passes away. The surviving spouse now with the same income pays a much higher amount in income tax. When you look at that as a percentage of now what is Uncle Sam getting out of that IRA, it's much, much more. So all the more reason we want to be employing these IRA-X strategies sooner than later if we can. Now,
yeah,
there's
most definitely.
Yeah. Now, sometimes tax planning kind of dovetails a little bit with the income planning, because in that conversation we're having with folks about when to take Social Security, from a tax standpoint, sometimes it can mean a lot to wait. Let me just give you a scenario. So somebody stops working, but they've got 5-6 years before they have to take their Social Security, or when they want to take their Social Security. Well, there's 5-6 years. We can be doing a lot of Roth conversions because they got a lot of room in that lower tax bracket. So that kind of dovetails with our income planning as well.
Yeah, and that comes back to, again, not just looking at it as we've referred to like year by year on the tax planning, but looking at it from a long-term perspective as well, like you're describing there, Larry, of the impact on your Social Security income, the impact on a surviving spouse. So there's a lot of benefits of looking at your taxable bucket and sort of what you could or should be doing over your lifetime to transition to tax-free. And if you're legacy minded as well, then obviously getting it over to tax-free can be very beneficial.
Yeah. Now, John, I want to move this into kind of like estate planning, kind of what we do there. Now we work with local estate planning attorneys because you have to be a licensed attorney to prepare the estate planning docs. But what we do in estate planning is we start beginning to have the conversations with the clients, and a good estate plan is when all your assets know where to go. And, so, what you're trying to do is basically avoid probate. So kind of explain a little bit about what that might look like.
Yeah, I mean, there's different ways that the estate planning attorneys will approach that, but typically it just starts with having a conversation with them to understand sort of what it is you're trying to accomplish. And really, like you said, Larry, the overall goal is to avoid the probate court process because you don't want any assets sort of left out there unclaimed because then it can ultimately lead to the long lost cousin or whoever it might be that thinks they're owed some money, and they might go and try and grab hold of that. So that's where you want to clearly lay out on different accounts. You can have beneficiary designations, but for those assets that I look at in times where you may want to or not want someone to receive a large lump sum initially, there's different ways that the estate planning attorneys can draw up trusts and everything to ultimately sort of receive those assets when you pass away and distribute those assets over time. And so there's a lot of different options out there, but that's where it's important to get an estate planning attorney involved.
Yeah, and John, I'm glad you mentioned that about the beneficiaries. That's what kind of dovetails with the wealth management, because as we set up accounts for clients, we always want to make sure that their beneficiary designations match what their estate planning is intending to do. So if they have a trust, what do the assets have to go back into the trust? We want to make sure that that estate plan is funded properly. And then finally, an estate plan is, having those tough conversations of, hey, when you find yourself not being able to make decisions for yourself, who do you want to make those healthcare decisions for you? Who do you want to have make those financial decisions for you? So we want to make sure we have those conversations so we can make sure the estate planning attorneys are addressing that as well. So I want to talk about long-term care healthcare planning, okay? And just remind our viewers, if you're not getting these kind of services with your present advisor, then I encourage you to give us a call, because we'd love to sit down and talk with you about where we could help. Most of this planning we're talking to you about today just comes with what we do for our clients through the wealth management side. So, and maybe you're already getting a picture about how all these have to kind of work together. Now, listen, in this segment, John, I want to talk about long-term care healthcare planning, right? What's kind of falls under that category? First of all, one of the questions we get asked quite often is, do I or do I not need long-term care? Wouldn't you agree?
Oh yeah, it's a major concern for folks right now, especially with the rising costs and sort of unknown, unpredictable costs that come with long-term care.
Yeah. Now, when I'm having the discussion with them, sometimes I want to put this in perspective for somebody. The average cost right now is a little over $100,000 per year for long-term care. I think the average stay is 3-4 years. So what's the threat to the estate? It's basically 300,000-400,000. Well, if I'm somebody that sufficiently has more than that in a portfolio, let's say I'm fortunate enough to be that person that has a couple $1,000,000. Well, really, is that a threat to their estate? Probably not. They can self-fund for that care, right? But if I'm somebody that only has, $300,000-400,000, and I'm looking at that threat, well, that's a bigger deal, right? I might be wanting to look at insurance, and right? Wouldn't you agree?
Yeah, and that's where I mean there's a number of different options to explore in that environment, and obviously need the appropriate insurance licenses and everything to walk through that. But it's looking at the traditional types of long-term care, or comparing that typically to some type of maybe life insurance plan that allows you what's called like an accelerated death benefit, where you can pull out the death benefit early to help pay for long-term care. So there's a varying range of options, but all of them, Larry, cost money, and that's one of those where trying to determine if that fits into the overall expense in the budget.
Yeah, and again, John, like we were talking about with the wealth management, all come with pluses and minuses. So really getting into the details and educating clients as to what they are really helps them in making, the best
Mm-hmm.
decision for themselves. I think the other thing that comes along with this kind of planning is, sometimes we'll have these people that retire a little bit early, and they're just trying to bridge the gap to age 65 when they can get Medicare, right? So having health insurance during this time is important, because they're no longer relying on their employer's plan, right?
Right, most definitely. And that's where, at least in today's environment, there's different subsidies that might be available if you're under a certain threshold for income. And so that's where it comes back to, again, income planning and potentially the tax planning piece of, do you have some money that's available that would be either after tax or tax free, that isn't going to impact your tax brackets, and therefore then the health insurance subsidies. So again, sort of coming back to, Larry, how all these different things that we're talking about on today's show really come together.
Yeah, they really do. Because, I can think of scenarios where I've had somebody 63, they've only got 2 more years till they can get Medicare, but they don't have to take Social Security yet, so they can keep their income fairly low and qualify for those subsidies under the Affordable Care Act. And then when they get to 65, now it's a whole different picture. So I love how that planning has to all be there year after year. The other thing that comes into play in this kind of planning is, now once they reach the age of 65 and they have Medicare, now they got another decision they have to make, because they got to decide, how are they going to get the supplemental insurance, right, to bridge the gaps that are there with Medicare? And they actually have two different ways they can go. They can go the Medigap route, or they can go the Advantage plan route. And most people find this out when they turn the year they're going to turn 65, because they get inundated by mail and all kinds of things, because the whole world knows they're getting ready to turn 65. But this can be very complicated. And where we come into play is we kind of walk them through that, right, John?
Yeah, that's where we found it valuable. We have a couple of the team members here that's their area of focus, and able to sit down and have a conversation to again, coming back to that education piece, educate you on, okay, if you go this route, here are advantages, disadvantages. If you go this route, here are advantages, disadvantages. Because again, it comes back to education, and unfortunately, like you said there, Larry, as soon as you turn that age 64, you're probably going to be inundated with information, and it comes back to getting good information so you can make an educated decision.
Yeah. Now, John, I just say, so there's all these kind of areas that we're dealing with, the wealth management, the income planning, the tax planning, the estate planning, the long-term care healthcare planning. It's basically anything that a client is going to need or have help with during retirement is there for them. And so the next question we'll get from people that maybe are viewers of this show is, when should I start talking with you guys? Well, we say it all the time. If you're 5-10 years away from retirement and you're starting to ask these questions for yourself about when to retire, what does it look like when I retire? Do I want an income plan? Then we encourage you. This would be the time to give us a call and start having those conversations. You have to understand, again, all these things have to work together. The costs, they're just planning that we do. It's part of the wealth management. If you have assets with us and we're managing those assets, all these other planning is going to be at no cost to you. Now, there's exceptions where, if we're working with the estate planning attorney, well, obviously they're going to have to get paid. But for the most part, the planning aspect of all this, we have a lot of knowledge in each and every one of these areas, and we can be, quite a help. And where we can't be a help, we know where to direct you to. So if that's you out there, I encourage you, give us a call. We'd love to, sit down. We are doing a lot of face-to-face meetings. We're trying to keep them to a minimum during, the pandemic. But we're making it safe for people. We're not having more than one client at a time. We're sanitizing things before and after they're there. We're trying to keep the social distancing. So don't let that be a deterrent. If you want to talk to us, we'll make a way to make that happen. We're doing a lot of Zoom meetings today. We can do that with you, or we can simply have a phone call if you're not comfortable with that. But by all means, give us a call. The number's on the screen. We'd love to talk with you. John, I thank you for joining me today on the show. And you viewers, thank you for joining us. See you next time.